Welcome back to the Deep Dive. Today we're taking something that feels utterly foundational, maybe even a little mundane, and we're going to turn it inside out. We are embarking on a deep dive into the certificate of deposit, the humble CD. Now, most people have the basic picture.
Right.
You lend your money to a bank for a set period, and in exchange, you get a fixed, predictable interest rate. It sounds simple. It sounds safe.
And it is marketed as simple and safe. Safety is, absolutely one of its core strengths.
Right.
When you look at the source material, the CD is formally defined as a time deposit sold by financial institutions, banks, thrift institutions, and credit unions, primarily here in the United States. And that key term there is time deposit.
That's the mechanism, right?
Yeah.
Unlike a standard savings account, which is instantly liquid, a CD imposes a restriction on access.
Precisely. That restriction, the fixed term, is the bargain. In exchange for you committing those funds for 6 months, 2 years, 5 years, the institute typically offers a higher interest rate than they would for, say, a standard savings or checking account. They get certainty and stability for their lending operations. You get a guaranteed return. It's a contractual agreement where the issuer, they expect those funds to be retained until maturity.
Okay, let's unpack that contract.
Yeah.
Our mission today is to move far beyond the basics. We're unlocking the hidden features, the complex market signals, the fine print that can act as a hidden penalty, and the powerful strategies that determine the real value of that fixed rate.
Yeah.
We want you, the listener, to walk away not just knowing what a CD is, but how to strategically deploy it, navigate the pitfalls, and truly benefit from this tool.
Because the CD is often treated as a completely passive holding tank for cash, when in reality, if you aren't paying attention to specific market conditions or that fine print, that passive approach can cost you real money.
It's not as set it and forget it as it seems.
Not at all. It requires active management and a deep understanding of the contract terms that govern your deposit.
So let's start right at the beginning. The anatomy of the CD. The name itself, Certificate of Deposit, sounds a bit old-fashioned. What are we actually buying today when we fund a CD account?
Well, historically, the name came from the literal paper certificate that was issued as proof of the contract.
The physical paper.
That's right. The paper certificate was the physical evidence, the original legal document. But today, that physical certificate is largely a relic. In the modern financial world, it's far more common for a CD to be a simple book entry item.
So it just exists digitally.
It exists only digitally, shown on your periodic bank statements.
So when we say book entry, we mean it's essentially an electronic ledger entry, correct?
Exactly. It's a record in the bank system. But the legal weight of that record is, paramount. If a consumer needs hard copy verification, say, for tax purposes or estate planning or just for peace of mind, they can still request a printed statement or just print one out from their online service.
But the function is the same.
The function is identical to the old paper certificate. The format is just digitized for convenience and, of course, security.
So functionally, the consumer provides a minimum deposit, and those funds are now locked away until maturity. The core promise remains. Interest is paid out at the end of that term, providing a guaranteed nominal return. But let's move to what drives that return. Why do rates differ so wildly, even within the same institution?
Well, there are several key factors outlined in the source material that drive the interest rate offered by the institution. We need to look at both the deposit factors and the institutional factors.
Let's start with the deposit factors.
Okay, the first is pretty straightforward. Principal size. A larger principal amount, a greater commitment of funds, should or may receive a higher interest rate. The institution is just willing to pay more for a larger guaranteed block of cash.
Makes sense.
The second factor is term length. A longer term usually earns a higher rate. This is standard logic in finance, right? The bank benefits from the certainty of having your funds for, say, 5 years instead of 6 months, and they compensate you for that extended commitment and the liquidity risk you're assuming.
Now, that usually is doing a tremendous amount of work right there.
It really is.
Because here's where the market dynamics become fascinating, and where the sources highlight a critical exception, the inverted yield curve. Yeah. This is where the standard logic gets flipped entirely on its head.
This is a vital economic signal, and understanding it is absolutely key to CD strategy. Normally, as I said, the yield curve slopes upwards. Longer maturity means higher compensation.
Right.
An inversion, however, means that short-term rates, like those on a 6-month or 1-year CD, are actually higher than long-term rates, like those on a 5-year CD.
So the market is defying that compensation logic. Why does the market do that? I mean, why would a bank pay me more to borrow my money for 6 months than for 5 years?
Because the market expects interest rates to fall dramatically in the future.
Okay.
This typically happens when the Federal Reserve has been aggressively raising short-term rates to combat inflation, but now the bond market, which is really the forward-looking consensus of millions of investors, is pricing in an imminent economic slowdown, maybe even a recession.
And when a recession hits?
The Federal Reserve will cut rates sharply to stimulate the economy.
So the inverted curve isn't just an abstract economic signal. It is a direct warning to you, the consumer, that future rates are probably going down.
Exactly. If the 6-month CD is paying 5% and the 5-year CD is only paying 4.5%, the market is signaling two things. First, it's a strong indicator of anticipated economic trouble.
Right.
And second, for the bank, they're desperate for cash right now at the short end, but they are also calculating that they can lock people into a lower rate, that 4.5%, for 5 years because they believe the rate environment will be much lower, perhaps 3% or even 2% in, say, 18 months.
Which means that during a period of inversion, the smart consumer action is the exact opposite of the normal rule. You should stick to the short-term, higher-yielding CD.
Precisely. You take the higher yield on the short term, giving you liquidity in 6 or 12 months. When that short-term CD matures, you can then reassess the market.
And if rates have fallen, you still got the high yield while it lasted.
You did. And if rates unexpectedly stay high, you can just roll that money into a new CD at the prevailing high rate without having been locked into the long-term lower rate of 4.5%. It's the market turning the standard logic on its head, and the consumer has to react strategically.
Okay, so that's the curve dynamic.
Mm-hmm.
Beyond the principal and the term length, what are the institutional drivers of the rate?
The third driver is the institution's size and type. The data shows a very consistent pattern. Smaller local institutions, often community banks or credit unions, tend to offer higher interest rates than larger national institutions.
And why is that?
Because they often have a more pressing need for stable local funds to support their localized lending activities, and they may lack the diverse funding streams available to these massive Wall Street banks.
And the fourth factor relates directly to that safety we mentioned at the outset.
Absolutely. The fourth factor is connected directly to risk and insurance. The source material highlights that banks and credit unions that lack federal insurance, so they are neither FDIC insured for banks nor NCUA insured for credit unions, they typically provide the highest interest rates of all.
Of course, they have to.
They have to offer dramatically elevated rates to compensate the depositor for taking on the significant risk that the institution could fail and the principal deposit would be lost. This is a critical warning sign for any investor.
A huge red flag.
A huge red flag. It also appears that account type matters. Personal CD accounts generally receive higher rates than business CD accounts, perhaps reflecting a difference in typical volume or the perceived stickiness of personal funds.
That distinction between insured and uninsured rates is just vital. If a rate seems suspiciously high, the first line of investigation should always be whether that deposit is backed by the full faith and credit of the federal government up to the statutory limit.
Absolutely. The risk premium is paid directly to you. If you are taking on 100% of the risk, you should demand a commensurately higher return, but often that return is not nearly high enough to justify the total loss of principal risk.
Let's circle back to the nature of the rate itself. We mostly talk about CDs as fixed-rate instruments, but the source materials discuss variable rate features, most notably the bump-up CD.
Yes, the bump-up feature is a great example of a consumer-friendly innovation that arose during periods of anticipated rate hikes. It became particularly popular around mid-2004 when the Fed began a cycle of raising rates.
Oh, what does it do?
The feature allows the consumer a single adjustment of the interest rate during the CD's term.
And what's key here is that the consumer controls that trigger.
Correct. The adjustment is initiated and chosen by the consumer. If you buy a 3-year CD at 4%, and 6 months later, prevailing market rates for new CDs jump to 5.5%, you, the consumer, can exercise your single bump option and have the bank reset your existing CD's rate to 5.5% for the remainder of the term.
That's a fantastic insurance policy against being locked into a low rate when the market is trending upward. It really mitigates that opportunity cost risk.
It does, and we see even more complex structures moving away from pure fixed income like market-linked CDs.
Right.
These are financial products that really blur the line between deposits and investments. Their performance is linked to the stock market, the bond market, or some other index. They are structured to offer the safety of a CD, often protecting the principal, but with the potential upside of market gains.
But they're much more complicated.
Significantly more complex. Their fees can be opaque, and the ultimate payout is never guaranteed, moving them far away from the simple, predictable nature of a traditional fixed-rate CD.
Let's move to the essence of the contract, the lock-in. The CD is inherently illiquid for its term. If you break that contract, you incur a cost. We need to understand the typical cost of early withdrawal and why that penalty structure exists from the bank's perspective.
The penalty is the mechanism that enforces the time deposit requirement. It's designed to be a significant deterrent, ensuring the institution retains the deposit funds as promised.
I see.
The bank relies on those funds remaining stable to manage its own asset liability matching, that is, funding its loans. If everyone pulled their CDs early, the bank's operations would be severely disrupted.
So what's a concrete example of that penalty?
The source material gives a very tangible illustration. For a 5-year CD, the penalty is often described as the loss of up to 12 months' interest. It can also be calculated as a fixed number of months of interest, regardless of the term length.
So that has to be pretty substantial.
It must be substantial enough that the withdrawal before maturity is only worthwhile if the holder has a critically urgent need for the cash, or if they have an alternative investment opportunity that yields a significantly higher return, an opportunity so good that it justifies paying the penalty.
So it's always a calculation. Penalty versus opportunity cost. Before we get to the math on that, let's look at the legal side. There are supposed to be protections in place so the consumer knows exactly what they're signing up for, right?
Absolutely. The foundational federal mandate here is the Truth in Savings Regulation DD. This regulation requires that insured CDs must explicitly state the early withdrawal penalty at the time of account opening. And critically, the long-standing understanding is that these penalties cannot be revised retroactively by the depository institution.
So you sign the contract, you know the terms, and those terms should be fixed.
They should be.
That sounds solid.
Yeah.
But the source material pulls back the curtain on specific real-world instances where institutions tested and perhaps breached the spirit of Regulation DD. This is where the deep dive into the fine print really matters.
It does. The integrity of that fixed penalty rule has unfortunately been challenged. We saw a high-profile case involving a credit union, Fort Knox FCU, which unilaterally modified its early withdrawal penalty structure and then applied that change retroactively to existing CD accounts.
Wow. So imagine you calculated your risk based on a 6-month interest penalty, and suddenly, mid-contract, the penalty is revised upward to 12 months. That radically changes the economics of your locked-in money.
It completely changes the game. And their rationale.
What was it?
They often rely on broad changeability clauses hidden in the boilerplate language, arguing that they reserve the right to amend the contract.
Oh, wow.
Another instance involved Main Street Bank of Texas, which closed a group of CDs early, before maturity, and did not pay the full accrued interest, claiming their original disclosure documents allowed them this drastic action.
That's alarming. In those cases, the bank essentially used the fine print to cancel the contract when it became inconvenient for them. It just underscores that even the expectation of a fixed contract is conditional on whether the institution inserted language granting itself the unilateral right to make changes.
Precisely. If the original written disclosure carries legal weight, which it does, the consumer must scrutinize every clause, because the institution may have inserted language that allows them to make these adjustments, potentially invalidating your entire financial plan, despite the consumer protections in Regulation DD.
Okay, let's transition to the strategic side. The refinancing decision in a rising rate environment. This is where the penalty, which felt like a massive wall, can sometimes be viewed as just a toll road, a manageable cost of accessing better returns.
This analysis is crucial for maximizing returns. When market interest rates are steadily rising, maybe due to multiple Federal Reserve hikes, the early withdrawal penalty may become insufficient to discourage redemption.
It's all about the math.
The logic dictates an active cost-benefit calculation.
Let's model that calculation out in detail.
Okay, suppose you have $100,000 locked into a 5-year CD opened 3 years ago, paying 2%. You have 2 years left. The early withdrawal penalty is 6 months of interest.
Okay, 6 months of interest on $100,000 at 2% is $1,000. That's your toll.
That's your toll. Now, prevailing market rates for a new 2-year CD are 5%.
So if I break the contract, I lose that $1,000. But what do I gain?
If you reinvest that $100,000 at 5% for the remaining 2 years, you will earn $5,000 per year, or $10,000 total.
Right.
If you stayed locked in at 2%, you would only earn $2,000 per year or $4,000 total. So the net gain from refinancing is $10,000 minus the $4,000 you would have earned.
So a $6,000 gain.
A $6,000 gain. Subtract your $1,000 penalty and you are still ahead by $5,000.
That makes the refinancing decision crystal clear. The added interest earned from the new higher-yielding CD more than offsets the cost of the early withdrawal penalties.
It absolutely does. And it moves the CD from a set-it-and-forget-it's product to one that requires periodic monitoring and action, especially during periods of aggressive rate hikes.
It's an active calculation that requires you to monitor market rates, not just the maturity date. This is one of the most proactive steps a CD holder can take.
Without a doubt.
Finally, we have to look at the critical point of maturity and rollovers. The danger here lies in depositor inertia. The danger of silence.
Yes. Institutions are required to mail a notice to the holder shortly before maturity asking for direction, withdraw the funds, or roll over into a new CD. There's usually a short grace window, maybe 7 to 10 days, immediately after the maturity date when the CD can be cashed out without penalty.
That's your safe zone for making a decision.
It is. But what happens if life gets busy, you miss the notice, and you don't contact the bank during that grace window?
This is the trap.
The risk is the automatic rollover. By default, or in the absence of specific directions, the institution may automatically roll the money into a new CD, usually for the same term lengths as the original. This is the liquidity trap.
And your funds are tied up again.
Your funds, which were supposed to become liquid, are tied up again. And what's particularly alarming, as noted in the sources, is that banks have been known to renew the CD at rates significantly lower than the original CD or lower than the prevailing market rate.
So by doing absolutely nothing, the consumer can be automatically locked into an inferior contract for multiple years.
Exactly. You may have opened the original CD at a premium 5% rate, and upon maturity, the bank rolls you into a new 3-year term at 3.5% without you ever noticing. It's a mechanism that favors the bank's stability over your need for optimal returns.
So what's the proactive move here?
A proactive measure every consumer should consider is specifying not to roll over when the CD is initially opened, if the institution allows that. If not, setting a calendar reminder for 2 weeks before maturity is just, well, it's non-negotiable.
We've established that the CD is a safe tool, but it comes with a built-in downside. The risk of locking you into a lower rate if the market rises, the opportunity cost.
Yeah.
We need a strategy to mitigate that risk. And that brings us to one of the most elegant concepts in personal finance, the CD ladder.
The CD ladder strategy is specifically designed to reconcile the desire for the high interest rate of long terms with the need for flexibility and periodic liquidity. The core principle is staggering your deposits.
So you're not putting all your eggs in one long-term basket.
Exactly. The investor distributes deposits over several sequential terms with the ultimate goal of having all money deposited at the longest term to maximize the rate, but structured so that a portion matures annually.
The genius is that you always have access to a portion of your capital, allowing you to capture higher rates if the market moves without ever committing 100% of your funds for 5 years.
Let's walk through the detailed example provided in the source for a 3-year ladder, because seeing it in action makes it really clear.
Okay, let's assume I have $30,000 to invest, and the best rate is currently on a 3-year CD.
You begin your ladder by depositing equal amounts, $10,000 each, into 3 different CDs. A 1-year CD, a 2-year CD, and a 3-year CD.
Okay, so I'm splitting the money.
You're splitting the money. Yes, the 1-year and 2-year CDs will offer slightly lower rates initially, but that 3-year CD gives you the highest initial long-term rate.
Okay, now fast forward to the end of the first year.
The 1-year CD matures. You now have $10,000 plus interest, which is fully liquid. This is your annual decision point.
Right.
Instead of just taking the cash, you look at the current market rates. Assuming the rate on a 3-year CD is still the best option, you reinvest that maturing $10,000 into a new 3-year CD.
Okay. So in year 2, I have the original 2-year CD maturing next, the original 3-year CD maturing in 2 years, and now this new 3-year CD maturing in 3 years.
Exactly. The original 2-year CD is now functioning as your 1-year block, and the original 3-year CD is now functioning as your 2-year block.
And the process repeats.
It repeats. We hit the end of year 2. The original 2-year CD matures. You repeat the process. You immediately roll that maturing principal and interest into a new 3-year CD.
So by the end of year 3, what does it look like?
You now have three separate $10,000 deposits, and critically, every single dollar is invested at the highest available 3-year rate. But because you started them a year apart, 1/3 of your total principal matures every single year.
So you've successfully maximized the long-term rate while retaining annual liquidity.
And the option to reinvest at whatever the current best rate is, or just withdraw the funds every 12 months.
It's truly a strategy that offers the best of both worlds: high term rates and high-frequency liquidity. But who manages this? It sounds like a lot of work.
Well, that's a key practical note. This responsibility falls entirely on you, the depositor. The latter is a strategic concept you execute. Your bank isn't going to set this up for you.
Which means you can do it anywhere.
It means you can distribute your ladder across multiple banks, which is often advantageous. As we mentioned, smaller banks frequently offer better rates, but they may not offer the full range of term lengths that a larger institution does.
So you can shop around.
You can actively shop around and cherry-pick the best rate for each step of your ladder, increasing complexity a little bit, but maximizing your return safely.
Moving significantly up the scale, let's talk about jumbo CDs. If the latter is for the individual, jumbo CDs are typically associated with institutional players and high-net-worth investors.
The definition here is all about size. Jumbo CDs are defined as having minimum deposits, which generally start at $100,000. Because of their volume and the specific needs of large-scale investors, they often offer slightly better interest rates than standard consumer CDs.
And who's buying them?
They're primarily bought by large institutional investors, pension funds, money market funds, banks managing liquidity who need stable, low-risk, and predictable options for massive pools of capital.
What's unique about their legal structure compared to the book entry CD we talked about earlier?
Well, they're often negotiable certificates of deposit and historically came in bearer form. We should probably clarify what a bearer form means.
Yeah, please do.
With a typical book entry CD, the bank's records explicitly show your name as the owner. A bearer CD means the certificate is owned by whoever holds the physical paper.
Oh, wow. So it's like a check that's payable to cash.
Precisely. It is transferable simply by delivery. While this offers liquidity, it also carries the inherent risk that if the certificate is lost or stolen, the bank will pay the interest and principal to whoever physically presents the certificate at maturity.
Which is why we don't really see them at the consumer level anymore.
Exactly. It's why most consumer-level CDs transition to book entry. It's infinitely safer because ownership is tied to identity, not just possession.
Okay, let's tackle the most complex product detailed in the sources, one that fundamentally transfers interest rate risk from the bank to you, the depositor. The step-up callable CD. This is the definition of a strategic trade-off.
This product is defined by its two key features, the step-up and the call. The step-up refers to the interest structure, which is designed to be highly attractive initially. The rate increases multiple times prior to the maximum stated maturity.
Can you give an example?
Sure. The source material describes a 15-year CD with interest rate step-ups scheduled for year 5 and year 10. The starting rate is typically higher than what you would find on a standard shorter maturity CD to compensate you for that very long lock-in period.
So a higher starting rate and scheduled increases. The consumer should be thrilled unless the bank exercises the call feature.
That's the critical mechanism. The call feature allows the issuer, the bank or credit union, to terminate the CD early and return the deposit to the investor after a specified time, usually at least 1 year.
And if the CD is called?
You get your principal back, but all future interest payments are immediately terminated. The long-term promise is broken.
So what determines when the issuer decides to call it? It sounds entirely dependent on the prevailing rate environment.
It is entirely dependent on market interest rates. The investor in a callable CD is fundamentally bearing the interest rate risk. Let's analyze the two scenarios for a 15-year callable CD. Scenario 1. Rates decline. If market interest rates fall significantly after the CD is opened, say, new 10-year rates drop from 5% to 3%, the bank realizes they are locked into paying you the agreed-upon higher step-up rates down the line. To save money, they exercise the call feature.
Of course.
They return the principal to the investor and immediately reissue debt at the new, lower prevailing rate.
And the investor is left holding cash in a falling rate environment. That's the definition of reinvestment risk.
It is. The investor has to take that cash and reinvest it in a market where every new fixed income product is offering a lower yield. They lost the benefit of the high long-term rate they thought they had secured.
So that's what happens if rates go down. What about if they go up?
Scenario 2. Rates increase. If market rates continue to rise sharply, say 15-year rates jump from 5% to 7%, the issuer is now happily locked into paying the lower contracted step-up rate. Even if it is increasing, they allow the CD to go to maturity because they would lose money calling it back and trying to reissue debt at the 7% current market rate.
So the bank wins, and the investor continues to earn less than they could on a brand new higher rate CD.
Exactly. It's a mechanism designed for the bank's advantage. The bank will only keep the CD running if it benefits them, which is precisely when it is least beneficial for you, the investor.
So that higher initial interest rate is just bait.
The conclusion is unavoidable. The slightly higher interest rate offered by the step-up callable CD compared to a standard CD is merely compensation to the investor for agreeing to bear the specific asymmetrical risk. The bank has purchased the option to bail out of the contract when it becomes expensive for them, and you are selling that option to the bank.
Safety is the foundation of the CD, so let's reinforce the structure of that security. Federal deposit insurance coverage.
This is non-negotiable for low-risk investing. In the U.S., deposit insurance is provided by the FDIC for banks and the NCUA for credit unions. The standard coverage limit, which has been in place since 2008, is currently $250,000 per owner or depositor.
That $250,000 is a hard limit for a single ownership category, but you can increase your coverage through structure, correct?
Absolutely. The $250,000 limit applies to deposits held in a specific ownership capacity at a specific institution. For example, if you have a joint account, the limit is $250,000 per co-owner, effectively ensuring $500,000 in that single joint account. If you have personal accounts, joint accounts, and IRA accounts, each of those ownership categories provides a separate $250,000 layer of protection. These limits are the absolute bedrock of CD safety.
But what if an investor needs to efficiently insure far beyond that $500,000 threshold, say handling trust funds or institutional money, without the complexity of managing accounts at 30 different institutions?
This is where specialized mechanisms come into play. While some institutions occasionally use private insurance in addition to federal coverage, the most structured solution for large sums is the CDRs program, the Certificate of Deposit Account Registry Service.
CDRs. It sounds like a centralized clearinghouse. How does it manage to insure millions through one single bank relationship?
It's brilliant in its simplicity and relies on the network effect. CDRs allows an investor to deposit, say, $5 million into a single account at their primary bank and still benefit from full FDIC insurance on every dollar.
How does that work?
The primary bank acts as a custodian. They break that large $5 million deposit up into increments, say, $249,000, and place those increments into CDs at 20 different FDIC-insured institutions within the CDR's network.
So the investor only interacts with their one primary bank, but their money is safely distributed among 24 underlying banks, ensuring no single institution holds more than the $250,000 limit for that specific depositor.
Precisely. It's an administrative simplification for the investor, allowing them to keep up to $50 million invested through one relationship with guaranteed federal insurance. They're essentially outsourcing the laddering process to the CDR's program itself.
That level of convenience must come with a trade-off, though. Is the convenience expensive?
Yes, the sources explicitly note the trade-off. Because of the administrative costs and the centralized management required by CDRs, the interest rates offered on these pool deposits will likely be slightly lower than the absolute highest rates you could find if you went shopping bank by bank and established a physical ladder yourself.
So you're trading a bit of yield for a lot of convenience.
You're trading off a small portion of potential interest for the guarantee of centralized management and full insurance across a massive sum.
Now let's dive into the legal contract itself, the terms and conditions. We've hinted at the power of the fine print, but the sources make it clear. The written contract holds all the power, often trumping verbal assurances.
It does. The federally required Truth in Savings booklet, or the specific disclosure document, must be made available before the purchase, and the consumer must internalize that this is a written, legally binding document.
And you can't rely on what the person at the branch tells you.
You can't. We stress this because institution employees, particularly those on the front lines, are often unfamiliar with the specific, nuanced details of every CD product. If a dispute arises, say after a merger or an early closure, the only thing that matters is the written word in that terms and conditions document.
Okay, so let's dissect the hidden clauses that the sources flag as dangerous, because this is where the contract moves from a benign agreement to a potential liability. Start with the idea of changeability.
This is the clause that undermines the fundamental promise of a fixed return. If the terms contain language such as we can add to, delete, or make any other changes to these terms at any time, you have signed away your expectation of certainty.
And this is what those banks we mentioned earlier used.
This is the clause that allowed the institutions in the legal disputes we mentioned to attempt to change penalty structures retroactively. If you agree to it, the fixed nature of your contract is potentially subject to the institution's unilateral amendment.
And then the necessity of checking for the callable clause, even if the CD isn't marketed as a callable product.
Correct. The standard CD terms must explicitly state if the bank or credit union has the right to close the CD before the term ends. If that clause exists, even if it's just boilerplate language, you have functionally purchased a callable CD. If rates drop, you are exposed to that reinvestment risk. You have to search for the word call or redeem early in the document.
What about the mechanics of interest itself? It sounds simple, but even the accrual process can hide details.
The contract specifies two things related to interest mechanics. First, whether interest is paid out periodically as it accrues, say, monthly, into a linked account, or if it compounds and accumulates within the CD until maturity.
Okay.
Second, and often overlooked, the contract dictates the precise date interest actually starts calculating. Is it the moment you deposit the funds, or is it the start of the next business month, or the next quarter? Depending on the timing of your deposit, a delay could cost you several weeks of interest.
Let's discuss one particularly chilling detail: the institution's contingency rights against a crisis.
Right. Every institution reserves rights, typically known as contingency rights, that kick in during extreme duress. Specifically, institutions generally have the contractual right to delay withdrawals for a specified period, sometimes 30 days or more.
And this is to protect themselves.
It's an explicit defense mechanism against a bank run, designed to give the institution time to organize liquidity or for federal regulators to step in during a severe financial crisis. While it's rarely invoked, the right exists in the contract.
We mentioned early withdrawal penalties earlier, but we need to look closer at the specific rules for withdrawing principal and the different ways penalties are calculated.
Rules for accessing the principal are rigid. Often, partial withdrawal of principal is not permitted at all. Any withdrawal below a certain minimum amount may require the closure of the entire CD.
Is there an exception?
There is a specific and important exception for U.S. Individual Retirement Account, or IRA, CDs. Because the government mandates distributions once you reach a certain age, the terms of an IRA CD typically allow withdrawal of IRA, required minimum distributions, but without incurring the standard early withdrawal penalty.
And finally, the ultimate pain point in the fine print: the penalty calculation itself. They are not standardized, and the way they are measured determines whether your initial principal is at risk.
That's absolutely right. The penalty calculation varies wildly. They may be measured in a fixed number of months of interest, like 6 months, or they might be calculated to equal the institution's current cost of replacing the money, which is a variable formula, or some other opaque formula.
But the most crucial question for the consumer is, can the penalty reduce the principal amount I originally deposited?
And the contract must be explicit about this, and the answer, worryingly, is yes, it can. If you open a CD with a 6-month penalty, but you withdraw the principal 3 months after opening, you've only accrued 3 months of interest.
But they want 6.
Since the bank demands 6 months interest as the penalty, they must recover the remaining 3 months worth of interest. They will recover that remainder directly out of your initial principal deposit. You have to know the precise language governing that penalty calculation before you sign, or you risk losing a portion of the capital you intended to preserve.
We've covered the complexity of the contract, the strategies, the insurance. Now we must address the ultimate financial truth of the CD, its relationship with inflation. This is the difference between the nominal return, the rate advertised, and the real return, your actual change in purchasing power.
The source material is very clear on this. CD interest rates are inherently linked to market forces and central bank policy, and they tend to correlate with inflation over the very long term. But correlation doesn't mean equality.
Right.
The great challenge is determining your real rate of return. You could have a scenario where the nominal interest rate is 15% and inflation is 15%, or a different scenario where the nominal rate is 2% and inflation is 2%. In both examples, your real interest rate, the increase in your purchasing power, is 0.
You just broke even.
You maintained your wealth, but you didn't grow it.
But the correlation often breaks down, especially during high-stress economic periods.
It does. We saw this, for example, during credit crunch periods, where banks may aggressively raise CD interest rates because they are desperate for funding. However, those rate increases may still lag behind rapidly accelerating inflation. If you lock in a 5% rate for 5 years, but inflation spikes to 7% for 2 of those years, you are actively losing purchasing power every month.
A painful lesson for many.
It was a painful lesson learned by many fixed income holders in the 1970s.
And here's where the tax system twists the knife. When we introduce taxes, the real return calculation gets worse, often making the high-rate scenario mathematically inferior to the low-rate scenario.
This is a critical insight often missed by casual investors. If we return to our 2 zero real return scenarios, the 15% rate 15% inflation versus the 2% rate 2% inflation, and we introduce a marginal tax rate of, say, 30%. In both cases, the government is taxing you on the nominal interest gain, not the real gain.
Walk us through the math on that.
In the 2% low-rate scenario, you earn $2,000, you pay 30% tax, which is $600, and your after-tax nominal gain is $1,400. Since inflation was $2,000, your real loss in purchasing power is $600.
Okay, a $600 loss.
Now consider the 15% high-rate scenario. You earn $15,000, but you pay 30% tax on that, which is $4,500. Your after-tax nominal gain is $10,500. Since inflation was $15,000, your real loss in purchasing power is $4,500.
Wow. By imposing taxes on the inflated nominal gain, the high-rate, high-inflation scenario results in a significantly higher negative after-tax real return than the low-rate scenario.
That is the consequence of taxing nominal returns. So if you are truly assessing the success of your CD investment, you cannot look at the advertised rate alone. You must look at the after-inflation, after-tax return. It is the only metric that matters.
This forces us to acknowledge the true and often limited role of the CD in a healthy portfolio. We have to take to heart the quote from financial author Rick Edelman, who stated plainly, "You don't make any money in bank accounts, in real economic terms, simply because you're not supposed to."
That quote is the ultimate context. CDs are not designed to generate long-term wealth or outpace aggressive market growth. They are designed for one purpose: safety and the preservation of capital for a short, defined period.
So for a down payment or an emergency fund.
They are the ideal place to hold money that you will need in the next 1 to 5 years. A down payment, a high-deductible insurance reserve, where the absolute priority is safety over growth.
Beyond interest rate risk and inflation risk, we must also address the fact that the economic value of an existing CD fluctuates like a bond when market rates move.
It's true. Just like other fixed interest investments, the economic value of an existing CD is inverse to current market rates. If you bought a 5 per CD and the current prevailing rate for similar products drops to 3%, your 5 per CD is now economically more valuable. If you were somehow able to sell it on a secondary market, you would receive a premium. Conversely, if current rates jump to 7%, your locked-in 5 per CD has lost economic value. While this doesn't affect your maturity payout, it affects the financial attractiveness of the asset if you had to break it early or, say, use it as collateral.
Finally, we must issue a severe caveat, a real-world warning that we cannot ignore. The danger of suspicion when rates seem too good to be true.
The sources are absolutely clear. Investors must always approach a CD offering an unusually high rate of return with extreme skepticism, particularly if the issuing entity is unknown, new, or uninsured.
A classic warning sign.
A classic warning sign. We have the tragic real-world example of con man Alan Stanford, who used fraudulent high-rate CDs to lure investors into what turned out to be a multi-billion-dollar Ponzi scheme. That high-promised yield was the bait, a clear sign that the institution was not legitimately investing the funds, but rather using new investor money to pay out the interest on old investor money.
So when looking for the best yield, the key is to ensure you are maximizing return without increasing risk.
Precisely. CD rates vary widely between institutions. The smartest, safest strategy is to shop around and actively take advantage of the best FDIC or NCUA insured rates available, because you can do this without increasing your risk exposure whatsoever. The risk level is fixed and guaranteed by federal insurance. The rate is purely a function of the institution's current liquidity needs and its administrative costs.
We've covered a remarkable amount of ground today on an instrument often dismissed as basic. We've seen the CD's true dual nature. It provides absolute safety, but if managed poorly, it can become a liquidity trap. We detail the power of the CD ladder strategy to mitigate opportunity cost, and we analyze the inherent interest rate risks the investor accepts in specialized products like the step-up callable CD.
And we broke down the contract language, seeing just how vulnerable a depositor is to unexpected changes in penalty structures, automatic rollovers, and even the potential erosion of principal if the fine print is ignored. Ultimately, we must focus on the after-tax, after-inflation reality.
So, what does this all mean for you, the person managing your own finances? Given that the terms and conditions are often written to allow for unilateral changes by the bank, and that automatic renewal can happen at a rate significantly lower than the original agreement, how does the initial promise of a fixed return change the way you must actively manage your money before the maturity date?
That is the final provocative thought. The CD promises certainty and safety, but its financial effectiveness relies entirely on the depositor's active responsibility. If you rely purely on the passive nature of the time deposit, you risk being trapped by a low rate, hit by a punitive penalty, or automatically rolled over into an inferior new contract. That fixed nature of the return is contingent upon your vigilance and your commitment to proactive management.
Active management, even for the most passive investment. That's a powerful principle to carry forward. Thank you for joining us on the Deep Dive. We encourage you to review your own CD terms and continue your research into maximizing your after-tax, after-inflation return. We'll see you next time.